In Arizona's real estate market, securing a loan approval doesn't mean your deal is done. Access to capital is rarely the bottleneck, execution is. Borrowers frequently start the conversation laser-focused on marginal interest rate differences and how fast a lender can promise to fund. Hard money financing is a bridge to get you through a transitional period. It is most effective when it directly supports an executable business plan, whether it involves a fix and flip, an auction purchase, or a short-term hold. Staring only at leverage or pricing metrics while ignoring whether the timeline works in reality is exactly how profitable paper returns fall apart before closing. One of the biggest misconceptions in private lending is that underwriting is just a property valuation. Experienced lenders evaluate execution risk. We visualize this through 3 evaluation pillars. First is asset quality, assessing the property's condition and renovation scope. Second, every loan requires a credible exit strategy, structured clearly for resale, refinance, or stabilization. Finally, borrower readiness. Missing documents or incomplete budgets stall underwriting immediately. A property might look highly profitable on a spreadsheet, but if the renovation timeline is flawed or the exit plan isn't realistic, the transaction will not execute. When closings get delayed, the holdup is rarely financial. In most cases, the borrower is already fully qualified for the funds. The friction happens on operational checklists. Unresolved liens, vesting complications, probate matters, and missing entity paperwork are what actually drag out the timeline. If a requested rehab budget doesn't align with the actual work required on the property, lenders will pause the process to request revisions and additional verification. Because operational hurdles require immediate attention and complete documentation, the actual speed of your deal is determined by your preparation before even submitting the application. Even straightforward renovations encounter delays. Permit approvals, contractor scheduling conflicts, and waiting on building materials can easily push project completion dates back by weeks. This chart shows what happens when timelines drift. As construction extends out, carrying costs steeply rise, eating into margins and complicating the strict seasoning requirements needed for a later refinance. Your financing structure needs to account for this execution friction. Realistic hold periods matter just as much as your starting interest rate. The most successful investments are structured practically from day one, avoiding overly aggressive leverage and ignoring best-case scenario speed promises. In competitive real estate acquisitions, certainty of execution is your primary advantage. The right financial structure ensures you can actually close and execute the project you planned.